Hey everybody, today is Sunday, June 2nd, 2019. Taking a look at the S&P 500, talking a little bit about oil and ES as we get ready to start June 2019. This is a free share uh, of a type of video that I do every weekend for the people who are members of my private account. It's a donor access thing. You can click on the GoFundMe link in my profile and it explains what the account is like, what it's about, and if you just make a donation, you can send me a file request to that private account at Kiwi24Carolyn and become a member over there. It's not a monthly recurring subscription. It's a one-time donation, and then any other kind of voluntary donations you want to make after that, if something that I've taught you has helped you to make a great trade and some money and you want to tip me, excellent. If not, just to be a member and be part of it, just make a donation and you're more than welcome to become a donor member over there. Anyway, back to our video. This is the S&P 500 monthly chart. This is our vicious May candle. Our vicious May candle that became a bearish engulfing of the April candle and literally split the baby in half here and doubled down for the month. When we closed up on Thursday night, we traded up into the 2790s, came back down, closed a little under 2790. We had a little glimmer of a chance, a little glimmer of hope that we might come in and pull off one of these stupid 50, 60 point end of month Friday rallies to get us back over 28.48, which is what we would have needed to do on Friday to undo this bearish engulfing state that the monthly candle is in. But we got that tweet planted right after hours on Thursday night that plunged ES down 30 points, that led to a huge gap down open on Friday that made us plunge a double down. I mean, it wasn't just enough to have a little bit of a bearish engulfing. We had to double it all the way on down. And that's what you see, like just a brick here, opening on the high for the month, closing practically on the low for the month, closing underneath the 10-month simple moving average, holding just above the 20-month simple moving average. If we were to take this whole candle and double it down again, or maybe double down from the break of the 20-month simple moving average, we would get down to the low 2500s in order to backtest what we came into the year at. Do a nice healthy backtest all the way down to the 2500s, hold above, the January lows, and maybe come in here, and as the course of 2019 continues on through the summer, maybe it would be a nice little back test of the 50-month simple moving average. I put a little dotted line on this to just sort of show you the trajectory of how this line is traveling. And, maybe as we got into the summer, we would come down here and back test the January lows and back test this 50-month simple moving average. You can see here this vicious sell-off in December took us down to a test of the 50-month simple moving average. And if you look all the way back here to the left side of the chart, this is where 26, that too looked like it was a test into the neighborhood of the 50-month simple moving average. Something about this thing that just makes managers who want to restock their shelves with fresh, brand new inventory, they'll come in when they see price get to that point and save the markets from the gates of hell. So that's something to think about. I'm not saying that that's happening now. This is something that could unfold over the course of the summer if the shit really starts to hit the fan and we do not recover. If we get deeper into a trade war with China, if we get into a skirmish with Iran in the Gulf, if we get into, problems with Brexit, with the changing of the guards and the new prime minister who's coming in starting the week after next over in Great Britain. So, those are the kind of things I'm talking about. I'm not talking about a flush this soon, okay? Anyway, let's take a look at something else that's a great leading indicator for us, and that's oil. Here's the oil daily chart. Look at where oil is at. Oil has traded all the way down to the low 50s. It has already traded back down through its halfway back point from the December low to the all-time high that it set here for 2019. I'm sorry, not the all-time high, that's on S&P. So just to the 2019 high so far. And as far as its low was concerned, it made its low one day ahead, made its 2019 high 1 week ahead of the S&P at April 23rd versus May 1st on the S&P 500. So if this is going like a week ahead, or it's just traveling ahead, or giving us a preview of what S&P is going to do as well, then we can see that if it has traded down through its halfway back point, the equivalent point on the S&P 500 is going to be 2650, another 100 points down from where we traded on Friday. So if we're going to follow through with more selling, even if we get a bounce first on the S&P 500, if we come back down and we break Friday's lows, think about that extra 100 point move down to match what oil has been doing. Okay, so just a thought as oil as a leading indicator. Here is our S&P 500 daily chart. This will show you that this is what we have next in front of us if we do not recover and bounce and get ourselves back above the 200 and the 100-day simple moving average and back up towards that 2850 level that we need to regain from a monthly standpoint in order to fish ourselves out of this this hole that we're in based on losing the lows of April. Even if we were to bounce back up here, if we were to come back down, we would be testing that 2650 level, and that's all the way down here. So you can see this is where we kind of took off from at the end of January and the beginning of February. Right in the forefront, though, if we are to head a little bit lower first before maybe trying a bounce, we have a gap to fill right ahead of us at 2743. This coincides with the open on the day, the close on the day that we put in the March low. If we are to trade through this gap and keep heading lower, then we would just simply go ahead maybe and test that March low. That March low was 27.22. Okay, this March low is pretty much, as you can see, where this leg pretty much was born out that got us to 29.54. This March low coincided with ES contract rollover in March. This was on March 8th. ES contract rollover was a lot earlier in March just because the first Friday in March was literally March 1st. For us here with June, for this next contract that's about to expire, our first Friday isn't until June 7th. So we've still got 2 more weeks before the ES contract rolls, and then 1 more week on top of that before it expires. And I can tell you from years of watching the screen, putting in that valuable screen time, which is the only way to really truly learn how to become a better, more informed trader, is to have screen time. And in those years that I've watched, we always get some sort of jackass wild swing of price getting trapped in it at a certain point, people rolling into the new contract, and then those who lag behind and don't roll with that contract, those who are keeping the contract around as a hedge, that aren't trading in and out of it on a daily short down below or stuck long up above, and they make these wild swings happen to just sort of trick people and trap them in above or below. And I think that we see that always happen, this wild erratic behavior centered around the ES contract expiration and the rollover. So if that's the case here, we've got about 2 more weeks, and if we get a bounce over the course of this week, and it takes us till next week or the week after that to come down here and test these lower 2700s, it's probably having something to do with ES contract rollover. If we are just going to continue to just travel downwards, but then we get some sort of hellacious bounce that really takes us back up, look at your calendar and see, are we on that second Friday? Are we heading towards that second Friday of June for when the contract rolls? Are we getting towards that third Friday of June where the contract expires? Okay, anyway, here is our S&P 500 intraday chart, 5-minute view, just to show you the intraday behavior of what is going on. Of course, you don't live and die and trade by what happens on a 5-minute chart, but only through the 5-minute chart can you see the shenanigans that go on and the importance of certain times of the day to be trading around. Here is our Friday gap down open. We traded down to our low of day within the first 30 minutes before data could come out at 10 o'clock. Then we traded up to our high for the day into the European closing bell. We took a look above the open, working our way into the gap a little bit, but met by sellers there right around 27.70, and then price just sort of deteriorated over the course of the day, tried to make a few bounces, but it wasn't until the very end of the day that we made a tiny little bit lower low, but not low enough to break the 27.50 handle. Why is this? Why did we stop at 27.70? Why did we stop at 27.50? It's because of the options market. We sit there and we trade during the week the different expirations of options, but portfolio managers, they'll go out and they are just buying the monthly expiration, the quarterly expiration, so on and so forth. And they're concentrating on the strikes that end in 00, 25, 50, and 75. You can look through the open interest on any expiration of the S&P 500 and always see the heaviest open interest at those expirations and specific month expirations. They buy those, and then they use all of the other expirations in between to short options to hedge those bets, to gain money that goes against their cost basis on what they paid for a long. I mean, they might pay $30 or $40 for a call, but over the course of the weeks leading into the expiration of that option, they'll short against it and short against it until they have that option for free. And then all of a sudden we'll get some big move one way or the other, and they get their payday on that long option, be it a long put or a long call. And right now, based on the S&P 500 and that monthly chart I showed you, it's probably the best thing right now until we get back above 28.50 or so. It's probably best to sell into the rallies because option players are probably selling calls anything above the 28.50 level. Okay, and as far as the puts go, up until this week, they were probably selling short everything against 27.50, and that's why we held the line there. Now, if they pull that safety net away and we drop, they're just coming in closer and selling closer and closer to the money, selling lower and lower short on calls and letting those puts run. And once we find a footing, maybe at 2,700, maybe they'll sell short against that up until the end of June, and then they'll let that go, and so on and so forth. And that's how we sort of walk the dog down here. Unlike in December, where it was just sell everything that isn't nailed down, and we took and in the course of 1 month, nobody was selling any puts. Everybody was just moving in and selling shorter and shorter and shorter and shorter on those calls and pressing us all the way down. Another thing I can tell you is that in all the years that I've been day trading, which is since 2005, some people might laugh who've been in the market since the 80s. I was an investor in the late 80s, but I didn't start day trading and moving my money as quickly as we do as intraday traders until 2005. But I can tell you that this is the first time in all my years that I ever saw a sell-off happen over Christmas. Even in 2008, when we had the global financial meltdown crisis, even in 2008, we had some kind of a bounce at the end of the year. So this was really probably the most vicious thing we've ever witnessed. So let this be a lesson to you that just because we're getting into, just because we've sold off and the market seems oversold, the market can get a lot more oversold. We could go all the way down here and take back 3/4 of everything we've put in gains this year if we have to, in order to get the message across to whoever it is that needs to do what they need to do in order to recover this market. And that would be the number one and the number two messages that we need to hear in order to recover this market are some sort of resolution on trade with China, and then with the Fed, some sort of resolution that they are willing to cut rates if the need be. Okay. All right, so I hope that this helped you out and got you a good start for Monday. Let's just take one last quick look at what needs to happen on Monday. In my opinion, I always use the halfway back point on a huge range day. I'll use the halfway back point for the day, and then I'll also take a halfway back point to the previous day's close when there's a big gap like this. And right now, I don't even need to calculate this. I can see that it's the 200-day simple moving average. We would need to trade all the way back up above this 200-day simple moving average in order to have a chance of getting to that gap. If we can't trade above the 200-day simple moving average, it's an opportunity to sell that rally and flip short. If we come into the day and we can at least recover 27.60, I think that gives us, that's a halfway back point for Friday's range, that gives us a fighting chance to make a higher high over Friday. If we can make a higher high over Friday, then we go after the 200-day simple moving average. If we can make it over the 200-day simple moving average, we keep on going and we try to fill the 100-day. But if we see sellers, if we see the ES order book heating up and showing sellers at 27.70, that means they're selling Friday's high. If we get out of that and we get up to about 27.75, 27.80, and we see sellers on ES, that means they're doing their thing with S&P options. They're selling calls, and they're going to push us down, and we're not going to be getting above the 200-day simple moving average. If we come out of the gate and we cannot even gain our heads up above 27.60 on Monday, then we look straight to that 27.50 where we toed the line on Friday. And if that breaks down, we just continue our journey down our roadmap. 27.43 is the next gap down. Below that, we have a big edge level left over at us from December. 27.28. We have to translate that with the spread on ES, so maybe 27 or so on ES. And then finally we get into those March levels that I talked about earlier in the video. Here is the March low. The March low, if that isn't held, leads way to a gap that takes us all the way down to about 27.09, 27.10 on the S&P 500. Okay, I hope this video helped you out, and if you'd like to join my private account, like I said, click the link that takes you to the GoFundMe page. The GoFundMe page has a really nice big explanation of what I do over there, and you make a $100 or more donation and you become a member for at least a year. You'll have a 1-year membership for $100 if you donate that. Okay, anyway, have a great rest of your Sunday. As always, good luck and good trading.